So thank you, Mr. Chairman. Thank you all for being here. And I want to pick up on that line. The question for me is not so much about the cost savings from all electronic trading. It's the question about the so-called high-frequency traders. And for me, the term high-frequency trading seems wrong. You know, this isn't trading. Traders have good days and bad days. Some days they make good trades and they make lots of money, and some days they have bad trades and they lose a lot of money. But high-frequency traders have only good days. In its recent IPO filing, the high-frequency trading firm Virtu reported that it had been trading for 1,238 days, and it had made money on 1,237 of those days. Now, I don't know what happened on the one bad day, but I assume a computer somewhere got fired. The question is that high-frequency trading firms aren't making money by taking on risks. They're making money by charging a very small fee to investors. And the question is whether they're charging that fee in return for providing a valuable service, or they're charging that fee by just skimming a little money off the top of every trade. So let me start there. Mr. Brooks, the defenders of high-frequency trading often claim that they provide liquidity to the market. There's always someone willing to buy whatever it is that an investor is selling. What's your view on that?
It's a great question, Senator. I think our view is that's a convenient answer by them. You know, the markets function pretty well prior to high-frequency trading strategies being adopted. You know, if 95 out of 100 times that you've said you want to buy 100 shares of GE, you cancel that trade, that expression of trading interest before anybody can get to you, I sort of question the true intent of what you're doing. Now, I think it's important to be clear, some high-frequency trading strategies are legitimate. They're market making. They're statistical arbitrage. They're buying stocks in a basket against an index or something like that. But a lot of these strategies really, our understanding, and by the way, I agree with both Mr. Solomon and Professor Scott, this market subject is incredibly complex, but so much of what a high-frequency trading strategy might be is to act, to draw a reaction, and then to profit from your reaction. So they flank you, they pivot around you. They really have no intention of trading. They just sort of want to see what you're going to do. And once they know what you're going to do, they can step in front of you.
Right. So you would argue this is not adding liquidity to the marketplace?
We think there's a huge difference between liquidity and volume. They trump the liquidity side, and we're like, wow, before you guys came along, we seem to be fine, or seem to be better in some respects. And I do think it's important here to identify that retail investors declare victory. You're in great shape. The $5 trade, instant access, awesome. But a big part of your portfolio, of your nest egg, might be invested with people like us. And in that part of the market, it's not such a good trade because you have people that are taking advantage of your being in the market for a longer period of time. When you're buying 100 shares, you're there for 2 seconds and you're done. You declare victory, you go home, it's great. But let's say you have 1 million shares to buy. I might be there all day. And all day, those other interlopers, if you will, have an opportunity to step in front of, take advantage of, sniff out our order, all those kind of things. And that's troubling to the market. That's where we could be better.
So I also think, by the way, that the liquidity providers are there when it's convenient for them to be there. So I would ask the question, are they really providing liquidity? Because I know if I'm an individual investor and I want to sell and I'm in a line with everybody else, they have no obligation to be there. In fact, arguably, when that starts to happen in the market, the thing that concerns me most is a lot of these algorithms look and trade off the same trends. So if we start to get one-sided in the market in the other direction, they will widen their bids and offers. And then we no longer have a market that has a responsibility to provide liquidity, a buyer of last resort.
So if I'm following you, Mr. Sullivan, you're saying that they're really adding volatility to the market, volume to the market, without adding true liquidity to the market.
It can be true liquidity. It's just not true liquidity when you might actually need to get true liquidity because there's no obligation. So they'll trade as long as there's liquidity. And we've seen in small caps, for example, when there's no activity, they don't trade until there is activity. Then they trade. And so that's not really providing that liquidity. That's like moths to the flame. There's a flame. Let's fly there. And so that's not real adding. It looks to the casual observer as if there's a lot of volume, but is there real fundamental buyers and sellers, or is it just a bunch of people crawling in there when they think there's real buyers and sellers around and creating activity that really doesn't add to the ability for Andy to aggregate a position or sell a position when he actually needs to do it? And I worry about the stability of the marketplace because when there is going to be, it's a matter of when there's selling, I wonder who's going to be there to actually buy it. Because in the old days, we may not have liked the New York Stock Exchange and the things that they did and the money they made, but they stood there and bought stocks in 1987, down big, but they bought them, and the market opened the next day. And here I'm a little bit concerned, particularly around the flash crash. What happened there? I don't really need to do a lot of studying. A lot of algorithms said, oh my God, this is unusual. I'm going to widen my bids and offers because I don't understand what's happening. And then everybody did it. And so we're no better today in that regard than we were in 2010. And I think that's actually the challenge in market structure, as opposed to whether HFT is good or bad. It is the market structure we live in, and HFT, sometimes it helps, sometimes it doesn't, but we're not in a good place market structure-wise.
All right. So thank you. And good. Actually, if I can just add to it, because the other argument you often hear is one about speed. That it speeds up the transactions. Mr. Brooks?
So our view on speed is, if your quest for speed is singularly focused, I think it's reckless. And what we've been led to understand about market structure and the quest for speed is when you're interested in speed, you remove safeguards and you remove some of the infrastructure and the underpinnings of the market. And so fortunately, the SEC put in the limit up, limit down, and some market-wide circuit breakers, and that's been great. But both the flash crash and the night capital situation were maybe driven by speed. And if that's the case, that's not good for anybody. As investors, it's rare that speed is important to us. Our average holding period is like 3 years. Why do I really care what's going to happen in a nanosecond?
Well, I was going to say, I take it the speed difference we're talking about is measured in milliseconds.
You can't even
not in 7 days.
It's milliseconds. It's right. It's nanoseconds, and that advantage, that speed advantage, if it destabilizes, it seems to us that that's wrong. That's not right, and we ought to push back on that. Our view is we really ought to just slow down, not walk away from technology, but let's take a deep breath here and really look at what we have. And I appreciate Professor Scott's admonition about the complexity of the market, but we've got to make some progress. My boss says to me, I don't really care how fast you're moving towards the goal, but please move in the right direction, will you? If I'm not moving in the right direction, I'm in trouble. We have not been moving in the right direction. Oh my God, we got Dodd-Frank, we got Volcker, we got blah, blah, blah. All these things out there, they're always there. There's always a reason why you can't do it today. We used to have a fellow who worked for us used to talk about the phrase, today is the hardest day to invest. There's always something that might preclude you from doing something. Today's the hardest day to go after difficult market problems because, gee whiz, I got something else I got to worry about. Can we just start to make some progress? Please. We don't have the answers. Pilot programs give you the opportunity to generate data, let the academics run wild, try and figure it out, move in very incremental, careful ways. It's right. You have to have a control. You got to know what you're trying to study and measure for. But we can do that. And I think we can do that in a constructive way.
Well, I want to say thank you very much, Mr. Chairman, on this. High-frequency trading reminds me a little of the scam in office space. You take just a little bit of money from every trade in the hope that no one will complain. But taking a little bit of money from zillions of trades adds up to billions of dollars in profits for these high-frequency traders and billions of dollars in losses for our retirement funds and our mutual funds and everybody else in the marketplace. It also means a tilt in the playing field for those who don't have the information or don't have the access to the speed or who aren't big enough to play in this game. So I want to see the SEC, the state agencies push forward in their investigations, and I think we should continue to do the same. Thank you, Mr. Chairman.
Thank you.